Whenever financial markets have a little whoopsie-daisy and require government intervention to prevent further losses, there is one line that is repeated more than any other.
Today's historic action will provide new retirement security to countless American workers and their families.
The troubles of the last few years has forced millions to put retirement on hold indefinitely. It's even forced some to cut their retirement short and re-enter the workforce.
And since I took office, the stock market has more than doubled, replenishing the 401ks.
Buy some stocks and they go down big. You got that paycheck coming. It's only older people who are further down the line who don't have enough paychecks left.
Americans' 401ks and retirement savings are booming.
Yeah, that's right. We can't let the consequences of our own actions go too far, because the retirement of millions of regular people are directly dependent on the performance of these financial assets. And well, they kind of have a point. Since the year 2000, the number of people actively contributing to investment-based retirement accounts has more than doubled over the same time in which defined benefit schemes have more than halved. At the end of last year, here in America alone, we collectively had almost $50 trillion worth of assets tucked away into retirement accounts, with all but $13 trillion of that being directly tied to the performance of financial markets. That is only slightly less than the collective value of our entire residential real estate market, and voters are equally defensive of it. People don't want their homes to lose value, and likewise, they want to make sure that at the end of their careers, they will have something to retire on. But this logical self-interest has created some perverse incentives for the entire financial industry by making hopeful retirees the ultimate bag holders for when things start to go wrong. Whether it's private credit, private equity, BDCs, mortgage-backed securities, or residential REITs, if there is an asset that is starting to go bad, then this practically unlimited pool of cash has become a great escape mechanism to bail out flailing sectors because they know that if anything goes wrong, the government will be there to bail them out in turn. This has created a weird scenario where retirement savings must simultaneously be protected at all costs while also taking on morally hazardous amounts of risk. It's not great, but at the very least, it has empowered people to take charge of their own financial destiny, right? Well, we will get to that. After that, we also need to address some good news, which is that America is far from the worst offender in this whole game.
Raising concerns about the security of her workers' retirement portfolios.
President Trump signed back in August, which directed regulators to expand access to 401ks, allowing retirement plans to include alternatives.
So if that goes down, then what they can pay you on a monthly basis goes down.
Cryptocurrency, real estate, the private market assets as well.
Ensuring Americans' hard-earned savings are invested in a sensible manner.
If we're right, people lose homes, people lose jobs. People lose retirement savings. People lose pensions.
Okay, so one of the most difficult parts about addressing this issue is that it's very hard to criticize the system of retirement savings we have without sounding like we are criticizing the idea of saving for retirement at all. As an individual, if you have the spare money at the end of the month, you absolutely should be saving and investing that excess to fund financial objectives, with what is hopefully a nice, long, comfortable retirement being towards the top of that priority list. What's more is that as an individual, if you can take advantage of tax-advantaged or employer-supported accounts like a 401k, IRA, or your home country's equivalent to make those savings and investments go further, you absolutely should do it. In the interest of transparency, I personally try to max out my allowable contributions when I can, partially because it's good financial discipline, and partially because Mr. Bagel would descend from Canada to slap me over the head if I didn't. But doing a sensible thing inside a broken system does not make the system itself sensible. Over the last 4 decades in particular, saving for retirement has changed a lot more than most people realize. For most of the post-war period, retirement in America was built on 3 things: Social Security, a company pension, and whatever personal savings you had managed to set aside on top of them. For most people, any combination of the first 2 felt very secure, normally with the third as a nice little bonus. Your employer legally had to stand behind that pension, and Social Security had just survived a world war. Almost none of that is true anymore. In 1980, around 60% of private sector workers with any retirement plan were in a defined benefit pension. Today, fewer than 15% are, and most of those are made up of senior employees at very traditional companies that have literally been grandfathered in, or specific government employees. Almost all of them have been replaced with the 401k, a tax-advantaged investment account offered through your job. You contribute a slice of your paycheck before tax, your employer sometimes kicks in a bit as a perk, and the whole lot sits in a menu of mutual funds until you retire. For the sake of technical correctness and completeness, the equivalent for nonprofit and educational workers is a 403(b). For state and local government workers, it's a 457(b). For federal employees, it's the Thrift Savings Plan, but functionally, they're all more or less the same thing. For anybody whose job doesn't offer any of the above, the backstop product is the IRA. Basically, a 401k without the employer attached. All of these share one extremely important feature. They are defined contribution plans. They define what you put in. They do not define what comes out the other end. What comes out the other end is whatever the market decides to hand you on the day you need it. For better or worse, that is a very different deal from the old defined benefit pension, where your employer was legally obligated to pay you a fixed amount for the rest of your life regardless of what markets did. And well, that shift from the employer owes you to you own a pile of stocks and cross your fingers was not an accident. The 401k started life as a weird little clause in the 1978 tax code meant to give high-ranking senior corporate executives a tax break on deferred compensation. It got turned into a mass-market retirement product in the early 1980s because it was cheaper for companies to offer, moved all of the investment risk onto the worker, and could be sold as empowerment. And it worked. According to data from the Investment Company Institute and the Federal Reserve, American retirement accounts held $49.1 trillion at the end of 2025, broken up between these various accounts. Now, beyond just simply being an enormous pile of money for the financial industry to play around with, this growing asset class has exactly the right combination of financial characteristics to make it a tax-advantaged, complacent bag holder that has ironically probably made retirement more difficult for average people for 4 distinct reasons. So it's time to learn how money works to find out who actually benefits when politicians line up to protect people's retirement. And, spoiler alert, why it isn't you. If you've watched this channel for any amount of time, you already know that most businesses do not actually care about your privacy. They sell your data, they lose your data, and they treat it like a line item on a balance sheet, which is why this video is sponsored by Cape. We've worked with Cape before, and they've added a bunch of new features worth catching you up on. Cape is a privacy-focused mobile carrier that gives you unlimited talk, text, and data, plus a stack of security features no other carrier includes. They recently rolled out IMSI rotation, which swaps the static subscriber ID your phone broadcasts every 24 hours so carriers and advertisers can't track you across time. They've also launched secondary numbers, 2 extra real phone lines built into your plan so you can hand them out for banking or shopping and keep your main line private. And finally, they've introduced disappearing call logs, which auto-deletes your call and text metadata after 24 hours, so there's nothing to leak or sell. Use code HowManyWorks33 for 33% off your first 6 months of Cape. Link in my description. Okay, so the first problem, and the one all the others get to hide behind, is that retirement accounts have quietly become the perfect bag holders. On paper, they are an extremely well-behaved pool of capital. 401ks and IRAs both carry a 10% early withdrawal penalty on top of regular income tax, which means most people don't touch them until their late 50s at the absolute earliest. That gives the funds managing them 2 things Wall Street genuinely loves: an extremely long investment horizon and extremely predictable liquidity needs. The fund manager doesn't have to worry about a flood of people asking for their money back tomorrow, which is perfect for owning illiquid assets like commercial real estate, private businesses, and private loans that are all very hard to sell quickly. These funds are also enormous, which means they can get into deals that most individual investors couldn't access even if they wanted to. On top of that, the fund managers running them are compensated for hitting steady returns inside a narrow risk band. And on top of that, most of the actual humans whose money is in these accounts have no idea what they are invested in, what the fees are, or what the real risks look like. Put all of that together and you have a customer that is captive, enormous, patient, oblivious, and politically impossible to let down. Because of this, more complex and illiquid products have actually become more desirable, because they simultaneously make it look like intermediate fund managers are justifying their own existence, but it also makes day-to-day price shocks harder to recognize as compared to something like a stock portfolio that has market pricing information updated thousands of times a second. We saw a version of this with mortgage-backed securities in the lead-up to 2008. Pension and retirement funds were quiet, but also enormous holders of the tranches that blew up. More recently, it's been private credit and BDCs being aggressively marketed into target date funds. And now, after last year's executive order, the big push is to make private equity and crypto products directly accessible to every 401k plan in the country. The same trillion-dollar private credit industry that has started to run out of good borrowers, looking at a $14 trillion pile of captive 401k money and seeing an exit door. And it all works because whoever gets to hold that money also gets to hide behind the phrase, "that's people's retirement" when things start going wrong. Now, to play devil's advocate, this wouldn't necessarily be a problem if people actually paid attention to where their retirement was being invested and were willing to accept those risks. But this issue also needs to be considered alongside the other problems with treating retirement savings as an endangered species that must be protected at all costs. So yeah, the second problem might not be that shocking to you, but it still needs to be considered. And that is that retirement savings held in these advantage accounts are overwhelmingly held by already very wealthy households. According to the Federal Reserve's most recent survey of consumer finances, the top 10% of American households hold the overwhelming majority of all retirement account balances. The top 1% on their own hold more in these accounts than the entire bottom half of the country combined. And to be fair, that bottom half of households have, on average, basically nothing in dedicated retirement accounts at all. The point is that when a politician says we have to do X because that's people's retirement at stake, the retirement actually being defended belongs overwhelmingly to people who are going to be fine anyway. The phrase "people's retirement" sounds like it is defending a plumber 3 years away from clocking out for the last time. In practice, it is defending the ancillary portfolio of someone who statistically already has a healthy base of personal wealth. Now, for what it's worth, this breakdown of retirement savings is actually a more equitable distribution of wealth than direct stock ownership, which skews even harder to the top. This is often used to highlight the power of these accounts to make long-term investing more equitable across all workers in the economy, but this still has some problems. For one thing, being slightly more equitable than regular equity holdings is not exactly a ringing endorsement. The second thing is that the households with a majority of these assets held in retirement accounts are largely the same households holding a majority of directly held assets as well. So really, instead of bridging the gap, it's adding further distance between these percentiles. And finally, well, you may be personally fine with this kind of inequality of asset ownership. At the end of the day, we do live in a theoretically capitalist, free market economy, and some level of inequality is just inherent in that system. But the difference is with regular asset markets, their inequality isn't tax advantaged. So yeah. Problem number 3 is that because these are tax-advantaged accounts, every dollar going in is a dollar that gets omitted from government revenue. And this is not a small issue. According to the Joint Committee on Taxation, retirement account-related tax breaks cost the federal government $383 billion in fiscal year 2025. This is a cost that is much harder to see because it is omitted revenue that just never comes in, rather than a budget line item that comes directly out of the Treasury. But to put that into context, $383 billion is more than the federal government spends on SNAP, unemployment insurance, child nutrition, and federal family support programs, combined, with enough left over to fund NASA as a cherry on top. To address this even more directly, it is also enough to just cut a $7,000 annual check to every single American over the age of 67. Now obviously, that is not going to fund a retirement by itself, but it would be a serious top-up to Social Security for every senior, regardless of whether they had spent a career maxing out a 401k or not. Now again, to play devil's advocate here, the argument is that these tax breaks encourage regular workers to save, which takes pressure off the governments to support them later, which might actually be a decent argument, if the tax benefit was spread evenly. But by combining problem 2 with problem 3, it really isn't, because the tax break scales with how much you can afford to contribute, and that scales with how much you earn. The vast majority of that $383 billion flows straight to people who are going to be financially comfortable in retirement either way. Of course, there are extreme examples of this, like Peter Thiel compounding billions of dollars worth of Facebook stock in his tax-advantaged Roth IRA. But more broadly, the majority of these advantages go to people who just don't really need them. It is a subsidy that gets sold as protecting the working class. It is, in practice, a transfer to people who can already afford to invest even without the tax breaks. Now on top of that, there is the argument that a private sector funded retirement is simply more efficient than a bloated government system without a profit motive. But the alternative is not exactly flawless either. Just because they have a profit motive doesn't mean it's your profit motive. Privately managed retirement accounts currently pay out tens of billions of dollars every year in management fees to the financial institutions moving all that money around. An exact number is hard to find, because the financial sector surrounding these retirement accounts is so massive. But a report by McKinsey estimated that roughly $84 billion in fee revenue could be directly attributed to direct contribution retirement accounts in 2024 alone. Those are all expenses that are not going to fund anybody's retirement, let alone the people that really need it. But even this is not the real problem. The real problem is that this whole arrangement was sold on one specific premise. It put people's financial destiny back in their hands. They are the ones taking the risk. They are the ones investing in markets. They get the upside. And yes, sometimes they will have to eat the downside. Again, to be clear, there is a certain appeal to having control over your own finances and not relying on an employer to pay you out a fixed monthly stipend. But that premise is, being honored very unevenly. Because the fourth problem, and the one that ties this whole system together, is that the people using these accounts are not actually being allowed to take the risk they are supposedly being rewarded for. Every time a sector of the financial industry that retirement funds have heavily piled into starts looking wobbly, the government steps in. Sometimes it's direct bailouts. Sometimes it's emergency liquidity. Sometimes it's quiet regulatory forbearance. Sometimes it's the Fed buying up an asset class that was never supposed to be its problem. In every case, taxpayer resources get deployed to keep something propped up because letting it fail would hurt, well, people's retirement.
And protecting Americans and their retirement accounts.
This new bill would make it easier to save for retirement.
Second panel will focus on protecting Social Security forever and strengthening retirement security for all Americans.
That is not, strictly speaking, private enterprise. That is a private investment account with a public guarantee quietly tacked onto the back end by political pressure. And the guarantee doesn't only show up as bailouts. It also shows up as red tape being cut, worker protections watered down, consumer protections weakened, and antitrust enforcement going quiet, all under the same argument. If we make this industry play fair, it might get less profitable, which might hurt stock prices, which might hurt 401k returns, which might hurt people's retirement. That was an incredibly effective lobbying tool, which is how you end up with a 20-year stretch where corporate profits hit record after record, wages stagnated, housing got unaffordable, healthcare costs exploded, and every attempt to regulate any of it got batted down by the same line. For the vast majority of Americans, stronger worker protections, genuine consumer rights, and a housing market that isn't an asset class first would be worth enormously more than a few extra basis points on a retirement account they mostly don't have much in. But the basis points come with the lobby. The protections do not. Now, the one piece of genuinely good news in all of this is that America is not even close to being the worst offender. Australia, for example, has a mandatory retirement scheme called superannuation, where a percentage of every worker's paycheck is legally required to go into a private investment account. That has given Australians the highest per capita retirement savings on the planet, and also a pool of private capital so enormous that the Australian government now treats it as a kind of general-purpose piggy bank. If the Australian economy is known for one thing, it is most likely its incredibly unaffordable housing market. But that market could only get so bad because Australian banks were willing to lend so much, and they were only willing to lend so much because they were so well financed, and a big part of the reason why they are so well financed is because Australia's enormous pool of retirement savings funnels a lot of that money into these institutions either directly through bond holdings and deposits or indirectly through equity. Data from the Australian Bureau of Statistics suggests that out of every dollar that gets put into these accounts, 27 cents gets directed towards the country's banking sector, which is in turn heavily focused on residential real estate mortgages. Or, when that isn't direct enough, these superannuation funds have also just cut out the middleman entirely and started investing in single-family homes themselves. In plain English, a large part of their infamous housing problem is funded by, and it is currently funding, the tax-advantaged retirement of primarily wealthy investors. It sounds bad, but it has also become a strange emergency fund for all the wrong reasons. Young Australians can now access their retirement savings to put a deposit down on a house, further adding tax-deferred fuel to that particular dumpster fire. Australians were allowed to withdraw tens of billions from their superannuation as pseudo-stimulus during COVID. And just this week, the Australian government quietly announced it would be tapped to help finance expanded military spending. So the good news, such as it is that we have not yet reached the point of using 401k balances to directly fund defense procurement. We are still just using it to bail out private equity. Which brings us back home, and to the uncomfortable bit. The obvious fix for all of this is actually not that complicated on paper. Stop letting the riskiest possible products into tax-advantaged accounts. Means test the tax breaks so they stop being a handout to people who are going to be fine already. And stop accepting That's People's Retirement as an automatic veto on any policy that might force Wall Street to behave or companies to face consequences. Now, this is normally the part where I say there wasn't some grand conspiracy behind all of this. It's just a broken system of people following their own best interest. But well, that actually might not be the case here. Convincing people that they are not workers or consumers, but rather investors, and therefore what was good for business was good for them, was one of the central focuses of a document you have probably never heard of, written over 50 years ago. But go and watch this video from our other channel, How History Works, to find out how it reshaped the modern corporate landscape of today with a level of accuracy that was clearly beyond just coincidence. And don't forget to like and subscribe to keep on learning how money works.